This is Justin Pulitzer. This is my weekend review for Sunday, March 13th, 2016. Good amount of material to cover, so let's jump right in. But first, I just want you to know, if you happen to be an early adopter here, watching this as soon as it's posted and the resolution isn't that good, just pause it for a few minutes or wait a little while and reload the page. For some reason, when I upload this to YouTube, they take their sweet time making the higher resolution versions available. This is actually being shot in 5K. YouTube doesn't even support that high. It does support up to 4K. So you should be able to get a beautiful high definition version of this, and it'll make the charts much more clear. So I have no control over how long that takes, the upload process. I just know it takes a little bit of time. If you happen to be watching this not right away, you're fine. Anyway, there's a lot to cover. Like I said, I usually start out with the 6 market keys, lead into now the officially 7 Fed keys, go through the major market indices, and then some of the important momentum stocks. So let's do it. So let's start out with the VIX. I created a VIX key. This was been for the last few weeks. A few people had requested I do this. Your wish was my command. If you'd like, you can pause the video and just review it. I don't want to go through each of them. They're pretty well stated here. So you can pause it, talk amongst yourselves, and then come back. Anyway, as I proposed in the last VIX video, or weekend review video where I covered the VIX, I had said we were starting to move from a period of more compressed volatility. You can see lower highs and kind of equal to lower lows, to a period now where we're starting to make higher lows and higher highs, although this last spike was lower than the last, and we're sort of just bumping around on the lower part of the channel. I suppose it's possible if this were to snap and we got some kind of blow-off rally, you can see a VIX greatly depressed. So keep an eye on this channel low. If we start taking out these lows here, like in the 15s and 14s, then I think we could see the 11s, and you'd probably get some kind of major spike into the end of the quarter. Keep in mind this is March, January, February, March. That's the end of the first quarter. Very important. That's the obviously the quarter right before kind of the summer lull gets started. I mean, they always say sell in May and go away, or do something in May. And these days, a lot of people front run that, and they do it in April. So just keep that in mind. I'm going to propose 2 potential scenarios into the end of quarter when I cover SPY. So pay a little bit of attention to that. One of them would be if this were to have this collapse here and we did get some kind of a blow off into the end of month. That being said, we are sort of getting toward the lower part of the channel, and I would be a little bit more cautious, and potentially the market is a little bit ripe for a pullback. So let's discuss that when the time comes. We all know the ECB, Draghi and co. Basically did a lot this past week. It had been kind of widely anticipated, I think, at this point, that he was going to have to, I don't know, at least show his bazooka, and I guess he fired it off. And I discussed some of the things that he did in the weekend review video. I don't want to get too repetitive in terms of like what was done and my take of that, but just the broad strokes. They lowered their deposit rate. It's now negative, meaning you have to pay to keep your money in banks there. They lowered their refi rate to 0. They expanded QE by 20 billion euros to 80 billion euros. They created some new LTROs that basically allows these banks to refinance. I think a lot of that is because they wanted to give them some room to take off some of the pressure from their commodity loan books, but that wasn't really stated, but that was sort of my read into it. They're going to buy some higher yielding assets, so that tells me that maybe they're making facilities for that to take some of that pressure off. But Draghi also said that they weren't going to be lowering rates any further, and that kind of got the market in a little bit of a tizzy. We'll discuss that when we get there, but that's what's going on. This week we have the Fed, and we're going to get a bit of a better read on what Yellen and co. have in mind. I will say this, though, after Draghi's actions and after the market's rally, it has now come up to in the mid to high 40% area that the Fed might move in June. I would say that it's highly unlikely that they're going to move in March here. We're going to get some information from them this week, but it is possible that June and afterward are basically back on the table. That would be the next, press conference event besides this one. So the dollar has responded here. It's been rather weak. We're making lower highs, some lower lows. You do have a bit of a double bottom here. If that gets taken, I think we'll see the end, the lower end of the range. But at that point, I'd probably be more inclined to maybe take a stab at a long dollar than be short. So we have a downward regression line that I've kind of unofficially drawn in. These always seem to be good, quote unquote. But anything below 25, 23, this is the UUP, by the way. This is the dollar ETF. Anything below here is vulnerable to still lower. Once we start getting above there, I start worrying about getting to the upper part of the range. Weaker dollar is good for earnings and stocks. I'm going to discuss a little later some of the reasons. Actually, I'm going to discuss it right now. Some of the reasons I think stocks have performed so well. Now, I'm going to kind of commingle, I guess, some of the six, or I should say the seven. Now it's official since they mentioned stock market volatility in their last statement. So it is now officially, I always say that there were 6 Fed keys and an unofficial 7th being the stock market, but now it's official since they are mentioning it openly. So I think that the reason why, we all know that the economic numbers have been kind of junky. We know that I've proposed to you that the jobs data, even though we're saying we have, a 4.9 to 5% unemployment rate, which is considered quote unquote full employment based on, I guess, economic theory, that the number is really a lot higher since you have people with lower quality jobs, people who are working part-time who want full-time jobs, and the fact that there hasn't been very much in terms of hourly wage increases. If anything, the hours worked have gone down, and I think, like I've said before, that's to avoid the Obamacare tax. So I think that the jobs number is really suspect. I've proposed in the past, I don't really want to get into my rationale for it here, that it's probably in the low to mid-teens if you really wanted to know a more accurate read of the unemployment rate. I've also discussed that the GDP in the country is really rather stall speed. We're kind of struggling to be a 2% growth economy, which is one of the weakest recoveries we've had in the history of the economy. You could kind of track that by the Atlanta Fed. I don't want to really get into those numbers, but they bounce around. It's funny. It goes from like 1.1% to 2%, then back down to like 0.9%. I mean, there's a lot of movement in this range, but the range is kind of meek and pathetic. So like, if you get a bump from like 1.1 to 2.1 or whatever, yeah, it's a full percent. It's a very large jump in terms of absolute change, but relatively speaking, it's still, basically just muddling along at a 2% economy. ISMs have been kind of junky, the manufacturing and the service, the PMI has been junky. I've proposed, though, that the good news here, the sort of the silver lining, is that the rate of change, the absolute numbers are not good. They're basically contractionary, recessionary, but the month-over-month looks have been slowing. So I always say, I've given the example that if you're speeding toward a brick wall at 100 miles an hour, the damage from that will be significantly more than obviously the pace that you get there would be significantly more than if you hit that brick wall going, let's say, 50 miles an hour or 40 miles an hour. So I think the good news with those numbers is that the absolute number is terrible, but the change in them, the gamma, if you will, is slowing. So that probably takes the probability or the likelihood of a recession. Not saying that we don't have, can't have a really crappy economy, which I believe we do, but the fact of a real full-on official blown full-on recession is greatly diminished. So that could also potentially put the kind of the Fed back on in play. I've said for a while I think that they made a very big policy mistake. You don't start raising interest rates into a stall speed economy, or one that was even declining as they were doing it. I mean, we all saw what happened in terms of the market, but that is the case. The kind of the silver lining here also extends a little bit into durable goods. We know that Boeing has lowered their production of, commercial 747s, the ones that they use for package delivery and stuff. They cut the production of that in half, which to me was very weak. But autos have been okay. Housing numbers have been kind of okay. I think a lot of that is due to the warmer weather, seasonably warm, particularly construction. I'll tell you, I live in an area where there's a lot of new construction, and basically, projects that would have been shut down the entire winter have been going the entire winter. So housing and construction numbers are, I guess, some of that demand was pulled forward, and people who would have probably been doing some more of this action in the summer were still going a little in the winter. I think also, if you take a look, there was finally, after people have had 10 months of basically buying nothing, they finally came out and bought some toasters and refrigerators. I mean, is that really, to me, healthy? That, to me, looks a little bit more cyclical than structural, so I guess we're in a bit of a cyclical uptick here in terms of the durable goods, which I guess, again, it's sort of muddle along and just takes a little bit of recession off of the table. But we're in a stall speed economy. Why are stocks holding up so well? And here we are. I sort of got us there. I took the long way, but we covered the Fed keys. We got there basically here by the bonds, the TLT. You can see that the 2009 crash high, this isn't it, by the way, but this is the number, 123.15. When the world was ending, that was where we got to. I'll show it quickly. You can see this was 2009, the spike high, and then rates, rose significantly. But look where we are up here. The rates are historically very, very low. They're actually lower than they were, like I said, when the world was sort of coming to an end. So what does that mean for us here? It means that stocks, and I've discussed this, and I may do a special edition video on this, are valued based on discounted cash flow model, DCF. And there is something called the discount factor that's known as the weighted average cost of capital, also known as WACC. And to make a long story short, to make kind of the DCF, I don't want to say for dummies, but DCF for, 2 seconds here. Basically, if you have a numerator and a denominator, just meaning a fraction, a simple fraction, you have a constant, let's just say, for instance, at this moment, a top number, and you have a bottom number. If you lower the bottom number, your end product stock price will be higher, and if you raise the bottom number, the denominator, your end product stock price will be lower. So we have historically low interest rates, meaning the lower number, the dividing number, is lower than it would normally be, and that has commanded a PE multiple premium in the stock market. That's why when we have low interest rates, and meaning a bond rally, it usually tends to be good for stocks. People get worried when you get spiky like this. They think it means recession. But in the end, stocks are valued, a very big component is the interest rates. And stocks are kind of the only game in town with low interest rates like this. And they also, projects that companies can invest in that would normally not be possible with higher interest rates come online. It sort of begs for more risky behavior. That being said, we've been having a little bit of a pullback in the bonds the last few weeks, and we're getting into some sort of support levels. Some areas I had discussed, 127s and 126s. So I would say that this area is going to be very telling. If you're short bonds, this is probably an area you want to start covering into. If you're looking to buy, I would probably start getting a little bit more motivated down sort of near the channel low. You also have a 200 MA that's kind of rising there. It's been a little resistance here. Moves above it have been unsustainable, but now that we're through it, I would think that it would support. So we have a 50 MA that we're kind of a little bit below, but just kind of hovering into some reference areas. And as we got down into like the 124s and 123s, I think that area you can see based on volume distribution should start having some price memory. So I think that there could be room for maybe a little bit lower in terms of TLT, but it's going to probably set up for a bit of a buy from that move. Considering, look where these have done. This was 128s. The low was before a bounce was about $10, and look where we are here. We're getting kind of we would be getting kind of close to about a $10 move if we got back into this area, and you can see where the volume kind of the price was, where the bodies were. People will start having muscle memory, so to speak, down there. So that's my thoughts on TLT. The main driving factor, and I'd like to say that, I can say that I was early on this, is oil. Algorithms are programmed basically with the S&P. If oil is rising, S&P futures rise. If oil is crashing, S&P futures go lower. So I don't want to go. I mean, I guess I could do it quickly. We could go back to the crash lows in 2009. You can see this was kind of the consolidation range around, between the 33.20 and the 37 area. We actually got below there, and I had talked to, I don't want to go back even further, but 25.26 was a ceiling for quite some time in crude before all of this kind of action happened, and that supported, and now we're bouncing back. So my thinking here is that crude is likely bottomed. Does that mean that it can't have a pullback and can't go down anymore? No. We've been riding a bit of an uptrend. It's getting a little steep along in the tooth here. There was some consolidation. We're kind of looking a little bit above there. But look where we are. We're at kind of the end of a volume distribution. I actually believe that we might go a little bit higher and kind of press up to this 200-day moving average just because. If you look on a longer-term chart, let's do a 3-year weekly maybe. Is that going to be enough? Look where these lows were on these hammers, the 42-ish area. And that's sort of really where like this real breakdown took place. There's also really where the volume distribution is on a weekly chart, the 42s, 43s. You have a 50-week MA up here around 45. That's around where these lows were. There was also a kind of trend line that didn't respect completely, but didn't really get too far below. And you can see it was resistance here, so it wouldn't surprise me to kind of kiss back to that area where all of this sort of muscle memory was. So I do think that there's probably still a little bit more up in the crude play to go. Yes, at any time there could be some type of a pullback. I would think that these highs here, like the 34s, 35s area, also where this volume distribution is probably, and 20-day moving average, and a now kind of flattening to starting to rise 50-day moving average. Those areas to me would be a good area to target for a kind of BTD, meaning buy the dip. The stocks that I like for these are kind of the same old. I've said that you want to kind of be in the ones that you don't have to worry about the dividend waking up and having the dividend cut, or you want to be in the ones that could kind of benefit from the lower oil prices, meaning snapping up assets or companies that are distressed for, cheap valuations. I think Exxon and Chevron are kind of the better ones. You can see there was a downward regression line. We're a little bit above there. We're also getting into sort of the muscle memory of where there is sellers. I will say this, the more times we bang into it, the better it is to get through it. But I believe, between 83s and 86s is a lot of resistance, and you kind of want to be more, taking profits as we have rallies, and then kind of buying the dips as we get more back into at least the middle or the lower part of the range. I don't know that we're going to see the lower part of the range again so easily, considering we now have a bending up 50-day, a 200 that's sort of flattening, and a 100 that's flattening, and we're above the 20. I think buying the dips or selling puts into down moves is the better play. I like selling like 75 strike and below. I think that those areas are okay. It'll likely coincide with getting close to the channel line anyway, and plus all this price memory down here where there have been lows. We're making higher highs and higher lows, so the pattern to me is starting to shift. Chevron just kind of went ape last week. You could see it's well above the downtrend line, making higher highs off higher lows. That CEO, I had said a few weeks ago, is like my new bromance. This guy just says all the right things. Take a look at the 200 MA. Moves above it were unsustainable. It had been resistance here. Now we're above it, held it. So I say you could be long Chevron against the 200 MA. You have 100 and 200 that are basically the same. The 50 is sort of bending back up. So I think pullbacks. I don't like chasing. I do think Chevron could see 100 again. That's really where this breakdown took place, 100-ish. So, yeah, I mean, there's still room to the upside. It could just go straight. But for me, risk-reward-wise, given that we're getting into some reference resistances, I prefer pullbacks, and buying, a little bit more on trend. I think we could redraw this trend line, though, at this point. You could kind of draw it from here. Let's see. Yeah, I like that a little bit more. So I would say you could buy the dip based on this based on the trend line, or some type of moving average or something along those lines. But this area to me would make a lot more sense than first chasing it here. If you're still long, I would be looking to trim and trail, so to speak. China, very important. We basically held a reference low, the 2009. I don't really want to have to flip the charts. Just trust me. I showed you guys it's the same thing like with the oil. We had a bit of a look below and fail. We're getting back up we're now breaking trend. Higher lows, a bit of higher highs, although this one's we're not quite higher here yet, into some past support, which is now a little bit of resistance. But I think that China may have, at least for a little while, seen the worst of it. I would be a bit of a buyer on dips. Anywhere in these 28s to 30s to me is probably a good area to kind of test your hand if you want to try long in China. It would not surprise me to see this continue up higher, to retest the backside of the old, where this real breakdown took place, and the backside of the old uptrend line, which is around the 36s. A lot of people ask me about BABA, so I'll just talk a little BABA. Getting a little bit overbought on the stochastics, although you can see this could last for a while. This had been sort of a bullish consolidation pattern that failed and basically pulled back. It did make a bit of a higher low here, and now we're making some higher lows with some higher highs. I like these. I had talked about this the other day, that we were kind of holding the 71-ish area, 70.99. You have an up tilting 20 MA, which is about to cross through a 50 for you MACD. The MACD mafia here. That's good. However, you do have a lot of kind of supply starting in the 77s, going up to like 80. That gets a little, maybe 81 for the gap fill. That starts getting a little squishy, squirrely. So if you're long, I like it based, if you want to use a stop, anything below this 70, 61-ish area, you want to be a little more GTFO. It really shouldn't see those lows again. But, I think pullbacks in BABA, as long as it's going to respect this uptrend line, can still be, it could still be a bit of a long. Another proxy for growth, which has not behaved well, is this IBB. And yes, I know all of the arguments. They've traded low PE multiples. They have tons of growth. The problem is this has a ton of political risk. You have Hillary Clinton, Bernie Sanders, Donald Trump, and Hillary even went so far as to mention Valiant by name, about going after them. So I'm a little cautious with this. I would be a little bit more interested in it down near these like 212s, 207s. For a right or right out play, you can see that would have basically traversed this whole rally. You had a head and shoulders top, a check back, a failed check back. This was starting to look like it was bottoming, slightly higher low. Then the flash crash, trying to form an inverse head and shoulders that kind of failed, and then a retest, three tops, and so this really should have gone, and it didn't. It had the breakdown. So you're making lower highs and lower lows again. It just kind of can't get out of its own way. To me, anything below these flash crash lows, which were 284s basically, to me is a little bit iffy. Also, the old breakout had been the 275. You can see that was a key number. Look at this when you had the gap. It was kind of gap and go. It's showing a lot of weakness. You could take a look at the leader of the pack here. I believe Gilead. I mean, look at this. It's basically respecting the 84, 88 lows with some look below action, but it's not really rallying. It's just sort of bear flagging here under the 50 MA. You can see the 50 MA here with some resistance. It looks to me like this, like it's sort of like setting up for maybe like another leg lower. I'm bullish on this stock in general. I think they have some really good products with sales, but if pricing is coming in, it could be a little bit iffy. I'm a little bit cautious, so I'd be looking to kind of sell the pops in Gilead. You've now built up a lot of supply up here. I'm sure these people are very anxious to get their money back. So I wouldn't, it's tough to play for these breakdowns like this, but, any rallies I would be kind of maybe looking to lighten up on here. Let's talk some commodities for a little bit. I meant to talk about this when we talked about the dollar, but you're seeing some impressive moves. Like you had this rounded bottom in gold. I think there's a lot of chasing money in here. I do think there's room up to kind of these reference highs in the 136s. Eventually, I think, believe it or not, this could even see 148s. I'll show you why I think that. If you look at where this really broke down here, look at these hammer lows, the 148s. It wouldn't shock me to see this come up here. And that's just sort of like the end of a volume distribution. It would be a break of the channel, but I think that could be in the cards. Short term, though, I would be you can see the 50 MA here. It moves above it. It had been unsustainable. I think at some point, at the very least, it's going to retest the 50 MA. So I would be, 50 week MA. I would be a bit of a buyer on dips there rather than chasing here after all these weeks up. Yeah, it could still keep going for sure. There's plenty of room to the upside, to these reference highs. There's a little bit like here. Look, I mean, you got to be thinking if you're a seller or if you're looking to be a seller, that you're going to at least see the 125s where 124, 125. But if you're first buying here, the thing basically ran 20 straight bucks, and now you're playing kind of for the last 5 or so, I think it's, a better buy on pullbacks, maybe to retest sort of like even just this sort of like cup and handle breakout here. If that coincided with the 50-day moving average, to me, all the better. Some other stocks, Freeport, this is starting to look like it may have seen the worst of it for a while. The thing got down to like $3. It's pretty bearish. It does have a little bit more room maybe to the 200 MA. I believe we could even rally up to the 17s. That's the 38.2% Fibonacci retracement. Usually when stocks are really weak, and that's just really from this leg. This goes back much longer, but I'm just talking from this last peak to here. Usually stocks rally when they're weak to at least the 38.2. If we start getting a turn in copper, it's very possible that happens. I'll show you on the 9-month daily. It's starting to look, we're making higher highs with higher lows. I don't know whether I'd be chasing this first up here, considering we're at a bit of a high volume node. But if there was some type of a pullback, I'd be interested in buying. I'm actually long a little FCX, so I'd probably be looking to add a little bit more on pullbacks, but as opposed to chasing it. Some of these stocks cut their dividends, like BHP, and that wound up being kind of the low. It's still in a bit of a downtrend, but looks like it's kind of trying to right the ship here. You can see it's kind of been holding the 100 MA. If you're long it, I think you can play long against the 100 MA. Anything below there, you might want to be a little bit more careful. But 20 MA is rising, 50 is sort of starting to flatten. So it's sort of getting me to think that maybe some of these commodity stocks have seen a little bit of the the worst of this situation. S&P. So, wow, this chart looks a little bit messy, but I do want to kind of take you out a little bit longer to show you the method to my madness. Let me just zoom in a little bit more here into the reference area. So, today is March 13th. You got to beware of the Ides of March, so to speak. The assassination of Julius Caesar. We're about 2 days out from that. Just a famous saying, beware the Ides of March. So March, like I gave when I was talking about the VIX, there is it's the end of the first quarter. There's two scenarios, likely scenarios I see for this playing out. And that is that we either rally into the end of the quarter, and then the last week there's lock-in and there's a sell-off, or there's a narrow window now that we kind of get into some of this resistance and then start aggressively pulling back, and then the last week of the sort of the quarter is window dressing, and they kind of gun it into the end of the quarter. So if we rally into the end of March, I would say it's a sell. And if we pull back into the end of March, it's sort of a buy. It's going to be a bit of a Costanza situation. So, keeping with our Caesar theme here, I'll do a little Shakespearean quote from Brutus from Shakespeare's book, Julius Caesar, Act 4, Scene 3. And it's, there is a tide in the affairs of men, which taken at the flood leads to fortune. Meaning that we could be getting to a important area for a right or right out in size test for a short. And why do I think that? Look at this. We've run up so far, so fast, although I will say the 20 MA has done a pretty nice job of catching up, particularly with this consolidation the last week or so, so it's not really as overbought. But we are coming into some important areas. I said we were over the 197.86. You can see on the ECB day that we had a bit of a look below and fail, and we came back up here. And I had said that this area to me was important. You had the double bottoms here, the hammers, and once they tried to look below those, but they couldn't rally it. And once those gave, we completely fell apart. So it doesn't surprise me that we had a bit of a pause here. And I had said that I thought that would trend, and the 61.8 could really be maybe potentially a top. And for a while it was. We had this down day, this just chop consolidation. And on the ECB day, I think a lot of people thought that this was just, bearish. And I was saying that, yeah, the bears had maybe had a little bit of an edge just because where we were in range, but it wasn't really, the breadth on the down day, it wasn't really a lot. Like at the worst on this ECB day, we were down like only 3-1 in the breadth. For a trending really crappy breadth day, you need 5-1, 8-1. We were 3-1. I mean, and by the end of the day, it was like maybe 1-1. Maybe 1.1 or less than 2-1. I mean, that's not really a bullish situation. I mean, a bearish situation. I mean, of course, it's not bullish because it's down, and we kind of had failed at an important area, but it was just sort of more neutral. And I had given the analogy to a roulette table, saying that maybe this was the bears had a slight edge with maybe double zeros kind of, but it didn't surprise me. The next day we had an up move. And I think a lot of bears held short this day overnight, and they just got their clocks cleaned. I mean, look at all the volume really came in. Once you got above the high, like I had said, you can use ECB days, sort of like Fed days. A move below the low would have been a short. A move above the high was a long, and these people all just got, kind of squeezed. They were the squozen. They were squeezed. We're coming in now, though, to some very iffy areas. The gap fill here was 203.87. That was really where this free fall kind of got started, and where the upper distribution kind of gets into play. So I'm thinking that there is some more up move, but, get back to my quote, with taking a situation at the flood, you might want to try right or right out short here at the gap fill for at least a day trade that could potentially come a swing. I'll probably be selling some out of the money puts at the very least of strikes, maybe as close to 210 as possible if I can, near dated, of course. But if there was some type of a gap up into this area, particularly after a few up days, I think that it could be at least a right or right out attempt at a short. Listen, I don't want to kid you and say that this is a bearish situation. It really is actually quite bullish price action. I mean, look at this. You had this big run up. You worked a lot of this excess off the last few days. I mean, you had 1, 2, 3, 4, 5, 6 days basically in this range. So, now we're above it convincingly with a close above the 200 MA. We're back up convincingly above the 197.86. We're above the 199s and the 200, and we even closed above the 201.90. I mean, that is bullish. I mean, it's hard to say it's not, but let's get the context. We're coming into all of these dead bodies. We had this kind of big rounded top up here. Let me go back. You have all the people who bought up here who were kind of hope and pray. Then you had more people who kind of came in here, and when this broke down, I think there's a lot of people in here who are probably going to be anxious to start getting their money back as you start moving into this area. So I think at the very least, selling some out of the money puts, out of the money calls, short near dated on rallies isn't a terrible idea. I looked at the expected move for next week. It's only about $3.69, which would imply a move up to 206.45 or a move down to 199.07. So take a look where that is, though. 206.45 is just below kind of this area where I drew in this reference support. That should now become resistance, I would think, between the 203.87 and the 206s. Look where this big red area is, where the big volume distribution comes in. I think selling out of the money calls in this area would be a good idea, and to kind of layer in maybe into some short as we rally back up and sort of to the teeth of where the breakdown took place. A move back down to the 199s is basically the low of this bar, 199.52. So if we get below this, obviously, if we get below this Friday bar, the breakout over the ECB day, to me, would be really suspect. I would already be really suspicious, to be quite frank with you, if we get below the body of that bar, which is here, the 201. It looks, let me zoom in a little bit more. 201. It's tough to do this. It's like, 201.28, 201.30. I would be willing to give it a little more room to the ECB high of the 201.07, but really below that body to me would be potentially a false breakout. You really shouldn't be seeing below that so quickly, and if you lost the low, I would be interested in either kind of peppering into a short up here for right or right out, or if we lost here, this body, I'd be interested in a row type of a situation, particularly if it was like on a gap, where it would probably go sideways. Maybe they would try to come up a little bit into there. I really would be, like I said, suspicious if we start losing the meat of Friday's move. It would be, to me, kind of like a look above and fail. So that's really what I'm thinking for next week. We are a little bit overbought here stochastically, and probably ripe for a little bit of a pullback, like I talked about in the VIX. But that doesn't mean that we can't have that kind of rally into the end of quarter ahead of time. So we're going to have to be on guard. Which one of those is going to take place? Are we going to rally into the end of the quarter and then sell off the last week for the lock-in, or are we going to sell off and then have the kind of the rally? I don't really know which answer that is, but I do know levels, and I know that we can play it based on the levels. A lot of people like to think they know a lot about things, and they're the ones, with all the... Listen, I like to get into the cerebral activities. You heard me here giving you quite a detailed explanation about how things can happen, but let's not BS each other. The levels are what matters. Anything below this 201.90, anything below this 201.30-ish area, to me, is really suspect. This, to me, would be like a look above squeeze that failed. Like if we were to... have another, let's just say Monday's candle has a lower high than this, you could say maybe that this is a good high to trade against. if we come back up into here, you probably want to be trimming. I've been talking about taking profits into the rally here. The time to be buying was really down in here, like when I talked about buying over the Fed day high. Now, this is sort of reaping the rewards of that, and you want to be sort of looking to kind of take profits. That's just my humble opinion. IWM showing still even more relative weakness. There is some room up here if it wants to fill the gap. It would be a little bit move over the 50% and getting close to like sort of the volume distribution. You can see it's not above the last swing high. It's below the 100 MA, not nearly as strong as SPY. It's below the box. So to me, this area is going to be tough if you can get back up into like that box area. The gap fill is even below the box. So I would say somewhere between the gap fill and the 114s. I realize that is quite a move from here, but I think that area to me would be a good right out short. It would probably coincide with SPY really well. The Qs, on the other hand, this is sort of a bit of a mixed picture. We have a bit of a double top in here. I realize it's marginally ahead, but I'm just going to say that this is sort of like a triple top. You have 1, 2, 3. Came down, kind of had a look below the box. We're still above it. You've had multiple days of consolidation, and now it's sort of trying to break out. We are still below the 61.8, so I guess relatively speaking, a little bit weaker than in SPY, but showing some potential. And I'll show you here, look, the why there might be a little more room up, because you have a 200 MA and 100 MA confluence up here in the 107s. The real breakdown took place in the 109s. And you're starting to get some life into the big boys of that indice like Apple, for example. It's had a decent amount of relative strength. It basically held these 92 double bottoms, consolidated, now healthily above the 50 MA. The 20 is now bent back up. The 50 is still downward sloping, but kind of trying. And, you basically got the move to 103. It pulled back like it should have. It had looks below this 100.72 that failed, and now it's trying to rally back up. I think you can be long if you want, with basically a stop below 100, and then you probably want to play short for a move to the 50 MA, or like some kind of move back into for the next 3 points into at least the 97s. But if you can get through 103s, I mean, you could see 105s, 107s, which are these lows, 105s and 107s, and even 109s and above relatively easily for maybe a move ahead of their quarter. I think a lot of people are sort of worried about this quarter because it's not going to have iPhone 7 in, and it's sort of the end of the 6S, which a lot of people think were disappointing. I know they have an event in front of us. They might be launching a smaller iPhone, the Watch 2, which I actually think is going to do pretty well. I know a lot of people anecdotally have been waiting for it. Even Apple store employees have told me they're waiting for the second one. I've been waiting for the second one, so I think that Apple probably would be a bit of a buy, but I really would love for it to kind of dump on this quarter. Like, it would be good if it kind of rallied, dumped into the quarter, sold off for the kind of the rest of the summer, and set up for us as a buy. But I am starting to get a little bit more constructive on Apple. I will say that. First time in a long time. Facebook, again, I did it again. I sold puts kind of down here once I saw that we weren't going to get. I was waiting for the 50, but it just wasn't acting right for lower. Unfortunately, I didn't post it, so I guess it doesn't really count. Although I do get to keep the money, which is nice. Now I got that going for me. We are sort of starting to rally back up. I had talked about selling them here and then closing them up here, and then I kind of put them out again here. Take a look why. It's the lower end of this distribution, and there's a 50 MA, so I just kind of got it in there. If we can clear the 110.55 to 110.65, I think the old highs will be in play. Would really surprise me if they weren't at least challenged, considering Facebook has been so bullish. I mean, this stock, just think about it. This company mastered the mobile. They're the only one in social that have really been doing well. And if you're a PM, a portfolio manager, and you have to invest your money into a social stock, you basically had dumpster fires in LinkedIn lately and in Twitter. I mean, this is the one that, you're not going to lose your job over investing in. They've been, I had a follower, this guy Johnny had asked me a while back, do I ever think that Facebook will overtake Google in terms of their, revenues and their profits? And I looked, and it turned out that Facebook was growing their top line. People were wondering at the time why Google was not performing and Facebook was doing really well. And it was really because of the accelerated revenue growth. Facebook is just killing it. They're taking market share. They are taking share from Google in the online advertising market. They are really monetizing and doing it quite well. The user data, Instagram, which they bought for $1 billion. I remember at the time everyone said, oh, they overpaid. It was that thing is worth like $35 billion now. As a standalone. I mean, that could be one of the best tech buys in the history of technology. Zuck is just killing it, man. He's I don't want to say the next Steve Jobs, because there was really, everyone always looks to say that, but I mean, he is like sort of the inspiration. He's like a Bezos, I mean, the guy, I just don't think Facebook has seen its all-time high. Yes, we got a big 1.618. I had talked about selling up here. It actually got a little bit higher, but I'm hard pressed to think that in 5 years Facebook is not going to be like one of these $500 types of stocks. I mean, yeah, sure, we could have a market collapse and it'll probably bite dirt for a while, but I think longer term that this stock is going higher. I know it's expensive on current multiples. It's like 89 times earnings or whatever, but they're growing like a weed. They're really making a lot of money, and I think that is just going to continue. And I think that multiple is going to look a lot less crazy based on their earnings in the next couple of years. So that's my opinion on Facebook. Amazon. I really have been waiting for a longer it did break the downtrend line here. We failed at the 50. I should say it failed at the 50. And now it's sort of back up there. So if you can get through the 50, you probably will squeeze to retest this high, maybe even a little bit higher to start filling in some of this gap. Seasonally, this isn't the best time for Amazon. It tends to do well in like kind of the end of the summer is when it bottoms, like July, August or whatever, gearing up for the holiday season. So I would be interested if, Amazon had some type of another leg down and kind of got into like these 400s or 300, high 300s. I don't know that that's going to happen. That's a really big move here, but I do know that it's making lower highs and lower lows. So until that pattern really kind of changes, which it's kind of trying to start, but not really, if you're long, the 200 MA here is the key. Look, it's basically look below has failed there. Here it held again. So I would say it's either a long over the 50 MA. If you're long already, you can use a stop, or short below the 200 MA. That's really my trade on Amazon. Long over the 50, short below the 200. Let's just keep it simple, stupid. Netflix showing a lot of relative weakness. I took a lot of heat saying that this was a double top in Netflix, and it sure was. We're basically back to the downtrend line. The frequency of touches, though, here is starting to get a little bit more narrow, which, if you're long and you're a bull, is good. However, we are below the 50-day moving average, and this bar didn't really exactly close bullish on a bullish day in the market. If there was some type of a gap up on Monday over these double-day highs here, over the 99s, I think it would be a runner, at least to the 205, probably. I think you'd catch a lot of people short, and I think you would see that. So that's how I would play it on Monday. It could be a gap and go. Wow, that could really be like the trade of the week if that really happens. Seriously, I think it would squeeze quite. It would be vicious. Particularly getting over this day's high here, the 101. This was really like sort of the breakdown. When you take out a big emotional day like this, it gets ugly fast to the upside and even to the downside. Like if this was a big up bar and you negated the bottom of it, think about that. Look here. You had this big these big up bars, and once you negated them, it kind of just it took some time, but once you negated those lows, it really took off to the downside. So I think that if you negate the high here, the 101.79, even just above these 2 days highs, like if there was a gap, it could be a gap and go. If you start losing the lows here of these days, though, these 96s and 95s, then I think we could have some sinkage, so to speak. For a long time, I've been saying that we are in 3-year daily, so we can just go back. For a long time, I've been saying I think we could see the primary trend and maybe the breakout here of the 70 area. That was really a key area, the 69.60. I know that there have been some analysts who've been looking for a retest of the 2007 top in like the 43s, 45s. I don't know if it's going to be that bad, although believe it or not, if the market goes into like a free fall and we're down 30%, you could be down there relatively very quickly. This, believe it or not, is only leg one kind of a down move. And if you look, it's sort of like the kind of the bounce back waiting for another leg lower. I'd be a very interested buyer in these like 63s to 70 area for a right or right out long. There's a lot of price memory down here. So that's sort of what I'm thinking with regard to Netflix. Believe it or not, over the summer, the stock usually tends to have pullbacks. I remember when they had the stars blow up back, in the 2000 before the 2007 peak. That's really, I don't know if it was 2007, actually. I was just trying to think. I remember I was in the Hamptons on the beach, and I just was watching the price action, and I leaped up, and I had a short Netflix, and for 2 days, it sort of did nothing, and then we had the stars news. But, I don't know, it just has a funny feeling to me like it might want to go a bit lower, as long as we're below this down, as long as we're hugging or below the downtrend line. So let's be either looking to be short below these lows or long above the 2-day high. That's my take on Netflix. Google acting quite bullishly. It was up on like that sort of the bearish day, when even at the worst, at the lows of the ECB. I've said for a while I don't really like playing Google. I have a hard time trading chop like this, and this is just the same thing. I'd like to buy it down on the channel low, or I'd like to short it up near the channel high. I'll keep it really simple, stupid with Google. That being said, context, it's been bullish. But anything below 752.05, I really think you kind of still have to be a little bit suspect. Priceline seems to have its Momo back. It had the gap, consolidation. We were well above those highs here. It looks like it wants to fill this gap to me, honestly. I don't know that it's going to be a straight line, but anything above 1280.97 to me is a long. Anything below there and this kind of consolidation bar to me would probably be a short. Like this would have been a look above and fail, and it would probably come down quite viciously to fill this gap. I was sort of honestly looking for this to do one of these gap and craps again, but now it's sort of like a gap and go, and the shorts are getting squeezed. So I would think 1378 at the least if this continues. If you lose this low a day, I would be thinking that it probably does start sinking quite low. Chipotle, doing basically what I said I thought it would do. We got consolidated, got back to the 532. News always falls along the line of least resistance. You had some employees with the neurovirus, the stock dumped. I was really looking for a little lower to the 50-day moving average, but these lows seem to have held. So let's treat this as like almost like an earnings day. Anything above 518.61 is probably a long, considering you have now 3 days worth of consolidation. Anything below 492.5 also with multiple days of consolidation and referenced lows here, hammers, I think is a short to the very least the trend in the 50-day moving average. So that's how I'm playing Chipotle. Really, really simple there. Let's go into financials. I always get criticized for not talking enough about financial stocks. I said I thought Goldman Sachs could have a little bit of room to the upside to retest the trend and the breakdown. I still think that. So I either want to be a short up here or a long down a little bit lower. I think a lot of people would think that this is a breakdown. They would get very nervous, but it actually would be primary trend. And I think it could set up for a little bit of a buy around there. It might even be a bit of a look below and fail. But usually when you have a head and shoulders with a breakdown, there is usually a check back. So I'm kind of waiting for that check back. JPM, sort of a similar situation. We know we had the diamond bottom. This is an island, a morning star or island reversal. Look at this. The last few days, pullbacks, 50-day moving average. You have a 20-day moving average here. I think you could be long against the 50. A break of the 50, I think you want to probably not be long or maybe even short. To be a bit of a valuation wonk, and we're going to end on this, is this AMBA. So the real breakout to me took place here above 36.49. You've had some look belows and just some chop below the trend line. It kind of got back up. Now it's back below. I want to do an exercise in valuation for you. Micron Technologies, MU, trades around 5 and change times earning. Qualcomm, with a lot of balance sheet cash, trades about 17 times earnings. If you were kind of to just take a happy medium of those, you're looking at 31s with a 12 multiple, which I think is, AMBA to me still has a lot of growth ahead of it. A 12 multiple, so that would be like $31. So I'm starting to get, believe it or not, based on valuation, and that, listen, that does not mean that, this wasn't rational up here. This is not going to necessarily be rational here. It's very possible there's another leg down, but I honestly want to be a buyer on that leg down. So I'm thinking to sell some out of the money puts, or to even start nibbling some shares in AMBA, doing a little bit of bottom fishing on weakness. That is a change for me again as well. Let's keep our eyes this week. Like I said, on SPY, are we going to have the run-up into the end of quarter and then the lock-in sell-off, or are we going to have the shake and bake where we pull back and then have the run-up with the window dressing into the end of the quarter? We have to keep an eye on that. Anyway, I've kept you guys long enough. It's 56 minutes. Be sure to like my video if you liked it. Please leave me some comments. I appreciate the feedback. If you're not following me on Twitter, please follow me. And of course, subscribe to my YouTube channel. Just hit the subscribe button. You'll get weekend review video notifications. You'll get Periscope rebroadcast notifications. You get special edition video notifications. How could you not want that? Anyway, let's have a good rest of our weekend. It's almost over, Sunday night. And cheers.